Credit scores are crucial to people who are interested in getting a loan, opening a credit account, even getting car insurance. This number determines interest rates that you'll be offered and whether you can even get insurance. Hi, I'm Roxie Dinstel with UAF Cooperative Extension Service. Let's take a look at what makes up your credit score. First, there are three major companies that keep credit information on most Americans: Experian, TransUnion, and Equifax. These are private companies that pull information from different sources, so your score will probably be slightly different from each of the companies. They all offer a Fair Isaac score, or you may be more familiar with a FICO score. Here's what goes into that score. 35% is based on your payment history, 30% is based on how much you owe, 15% on the length of your credit history, 10% on new credit, and 10% on types of credit. The first thing any lender wants to know is whether you've paid past credit accounts on time. This is one of the most important factors in a FICO score. Just having a late payment or two is not going to tank your score. If overall you have a good credit history, one or two late credit payments aren't going to matter much. At the same time, no late payments doesn't guarantee that you're going to have a great score. It's just one part of the overall numbers. Those things that will affect your credit report include bankruptcies, which stay on your report from 7 to 10 years, foreclosures, lawsuits, wage garnishment, liens, and judgments. The scores also factor in how late payments were, how much was owed, how recent they are, and how many late payments there are. Owing money doesn't mean that you'll always have a low FICO score. But when a large percentage of your available credit is owed, that's a red flag. It might indicate that you're overextended and that you're likely to miss payments. Even if you pay off your credit cards in full each month, your credit report is based on the amount of that last statement. Another factor is the amount owed on different types of accounts. For instance, the amount on installment loans and the amount owed on credit cards. Having different types of accounts and handling these accounts responsibly is favorably considered. In some cases, having a very small balance without missing a payment shows that you've managed your credit responsibly, and you may be better off than carrying no balance at all. How many accounts have balances? A larger number of accounts with amounts owed can be a sign of overextension. How much of the credit line is being used? This is called the credit utilization score. If you are close to maxing out on several credit cards, you have a high credit utilization and you may have trouble making payments in the future. When you have a low credit utilization score, it can be more favorable than having a high one, or for that matter, none at all. I often get questions on whether to close credit accounts that are not being used. Think carefully before closing an account. For example, you have two credit accounts, one with a $5,000 credit line. You don't owe anything. The second with a $10,000 line, and you have a balance of $7,500. In considering your accounts, you have a $15,000 credit line and $7,500 owed, or about a 50% credit utilization score. If you close the account with no balance, you have a 75% utilization. Look carefully before closing that extra account. How much of the installment loan amount is still owed compared with whatever the original loan was? In other words, if you borrowed $100,000 and you've paid $20,000, you still owe 80% of the note. This also comes into play when a house is refinanced. The house may be worth $200,000, but if you refinance for $100,000, the percentage of the loan paid is based on the lower number. You might consider the house in this example as only having 40% of the loan left, but because you refinanced, the FICO score would be considered that your house still having an 80% loan. Paying down installment notes is a sign that you know how to handle and to manage your credit accounts. A longer credit history will increase your FICO scores. Think of these factors. How long have you had these credit accounts? Consider the age of your oldest account, your newest account, and the average age on all accounts. How long has it been since you used certain accounts? Think hard before closing older accounts, even if they're no longer used. The types of credit is another consideration for FICO scores. Your mix of credit cards, retail accounts, installment loans, and mortgage loans will be evaluated. Having credit cards and installment loans with a good payment history will raise your FICO scores. Despite owing nothing, people with no credit cards tend to be viewed as higher risk than people who have managed credit cards responsibly. How many accounts do you have? This will also affect your score. If you've opened several credit accounts in a short period of time, you're considered to have a great risk, especially if you don't have a long credit history. People tend to have more credit today and shop for new credit more frequently than ever. FICO scores reflect this. However, research shows that opening several new credit accounts in a short period of time represents greater risk, especially for those who don't have a strong credit history. In summary, remember that there are 3 major credit reporting companies: Experian, TransUnion, and Equifax. Each company has different rating processes, so your score may be different from each company. Your credit score is important and is based on a variety of factors. Here's the breakdown. 35% on payment history, 30% is based on how much you owe, 15% on the length of credit history, 10% on new credit, and 10% on types of credit. Knowing what your score is the key to learning how to improve your score.